In today's video, we will go through the ultimate beginner's guide to candlestick patterns, covering what they are, the different parts of the candlestick, and finally some patterns to get you started on your stock trading journey. If you want to become an investor, trader, or want to make money in the market, you will need to have mastery of what the price action is showing. Today, this task would have been impossible if a Japanese man in the 17th century had not come up with it. This technical analysis of price action, which we're talking about, is known as a candlestick pattern. Before we begin, make sure to like this video and subscribe and turn notifications on to be notified whenever a new video comes out, so you can receive all the latest financial tips that we have to offer. Also, if you know someone who would benefit from this video, please share it with them. In today's video, we will be covering the entire basics of candlestick patterns for beginners. We'll also be discussing what they are, along with the 11 most common candlestick patterns to get you started finding these patterns to help you make money. What are candlesticks? Candlestick charts are called that because they use what resembles a candle for the price of action of the commodity. This method originated in Japan over 100 years ago by a man named Homa. He discovered a link between price and the supply and demand of rice, which were strongly influenced by the emotions of rice traders. Candlesticks indicated that emotion by visually representing the size of price moves and with different colors. Stock market traders adapted this technique to visually show the price action of a stock in the stock market. Stock traders use candlesticks to make trading decisions based on frequency occurring patterns of multiple candlesticks, which help them forecast the short-term direction of the price. Similar to the case of the commonly used bar chart, a candlestick shows a market's open, the high, the low, and closing price for the day. It has a wide part which is called the real body. The real body represents the price range between the open and close of that day's trading. When the real body is filled in or black, it indicates that the close was lower than the open. If the real body is empty or white, it means that the close was higher than the open. Talking about candlestick basics, let's start with longer and shorter bodies. The longer the body is, the more intense the buying or selling pressure. In contrast, the shorter the candlestick body indicates little price movement and represents consolidation and low momentum. Moving on to the wicks, or sometimes called shadows. When the wick is short, it reveals that the stock's trading activity stayed between the opening and closing prices. Conversely, when the wick is long, it signals that the price action has crossed the borders of the open and closed prices and has retreated from the peak action of the day. A strong high and weak close creates a long upper wick, while buyers stepping into the close of the trading day to push prices back up, it means that a long lower wick will form. That covers all the basics of a candlestick. Now let's talk patterns. Basic candlestick patterns. Candlestick patterns are created by ups and downs movements of multiple candlesticks over a period of time. These patterns are separated into bullish and bearish behaviors. Bullish patterns indicate that the price is likely to rise after the pattern is evident, while bearish patterns indicate that the price is likely to fall once the pattern reveals itself. Of course, this isn't financial advice, but financial education for you to learn. I want to see you benefit from this, but please, use it at your own risk. Now let's go through the 11 most common patterns to help you identify them on your own. Number 1. Bull flag. Starting off, we have the most famous one, the bull flag, a chart pattern that occurs when a stock is found to be in a strong, rapid uptrend, then consolidates for a while. It's called a flag pattern because when it is seen on a chart, it looks like a flag present on a pole. And since we are in the state of an uptrend, it is considered to be a bullish flag continuation pattern, as the stock prices tend to go up after the flag has printed. Number 2. Bull pennant. Similar to a bull flag, we have the bull pennant. The bull pennant is a bullish continuation pattern that signals the extension of the uptrend after the consolidated period has passed. Unlike the bullish flag, where the price action consolidates within two parallel lines, making a sideways flag, the pennant uses two converging lines that look like a small triangle or pendant for consolidation until the breakout occurs. Again, as this pattern occurs in an overall uptrend, the continuation for the stock price is to keep going higher. Number 3. Bull ascending, wedge, triangle. The bull pennant is very similar to the bullish flag. Both of them consist of two phases, a strong uptrend and a consolidation phase. These are patterns that don't take much time to form, and the breakout can occur quickly, as short as within a week. However, when longer time frames are considered, a bull ascending wedge or triangle can become evident. This pattern forms over weeks to months and can be very bullish once it breaks out to the upside. The ascending triangle usually occurs at a level of resistance and keep challenging that resistance until it eventually breaks out and the price continues higher. Number 4. Bear flag. Now moving on to a couple of bearish patterns. First is the bearish flag, similar to the bull flag, but this pattern occurs in an overall downtrend. This too is a continuation pattern. First, a sharp drop in price to make the pull, followed by a period of consolidation to form the flag. And once the bear flag reveals itself, the price will break down and continue lower, breaking to the downside or the lower part of the flag. Number 5. Bear descending, wedge, triangle. A bear wedge is the opposite of a bull wedge. It occurs or makes up the overall downtrend. This pattern forms over weeks to months and can signal there are major problems with the stock, and more downside is in the future. The descending triangle usually occurs at the level of support and keep challenging or bouncing off that support until it eventually breaks down and the price continues lower. Number 6. Cup and handle. Next up, we have the cup and handle, which is a bullish pattern. This pattern resembles a cup and a handle where the cup is in the shape of a soft U, with matching price tops forming the two rims, and the handle has a slight downward drift after the second rim. A cup and handle is considered a bullish signal, extending an overall uptrend as it occurs during a period of consolidation after a price rise. The cup and handle can take anywhere from a few weeks to 3 months to form. Analysts and traders use this pattern and place a buy order slightly above the upper trend line of the handle pattern. If the stock breaks to the upside of the handle, this signals a strong bullish continuation and the price should increase higher than the two rims. The upside target is measured from the bottom of the cup to the rim. That price is then added to the top of the rim to give an initial price target for selling. Number 7. Head and shoulders. The head and shoulders pattern tells a conflict is present between bulls and bears. The pattern starts with an initial rally and pullback. Then, the bulls rally the price higher again, past the initial peak to reach a new high, but that momentum fades and the price decreases for the second time. Finally, the bulls try one last attempt to push the price upwards, but manage to only hit the lesser high than their second attempt. These 3 attempts form what look like a left shoulder, head, and a right shoulder. The lower part of the shoulders is called the neckline and is considered support to price decreases. When a price breaks down below the neckline of the shoulders, signals a bearish continuation and more downside. The downside price target is measured from the top of the head to the neckline and from the neckline lower to give the initial price point at which the selling will stop. Number 8. Inverted head and shoulders. Like the head and shoulders but upside down, the inverted head and shoulders is used to predict reversals in downtrends and mark bottoms. This pattern is identified when the price falls to a low and then rises, forming the left inverted shoulder. Then the price falls lower than the first low and then rises back up to the neckline again, creating the inverted head. Finally, the price drops again, but not as low as the head and rallies back to form the right inverted shoulder. The upward parts of the shoulder are now called the neckline and is considered resistance to price increases. A break above the neckline of the shoulders signals a bullish continuation and more upside. The upside price target is measured from the bottom of the head to the neckline and from the neckline higher to give the initial price target for selling. Number 9. Hammer Candle. A hammer candle pattern is a bullish pattern that forms in a single day. It occurs when a stock trades significantly lower than its opening but rallies within the trading day to close slightly higher than the opening price, forming a large lower wick. The lower wick, or shadow, in a hammer candlestick is at least twice the size of the real body. A hammer occurs after the stock has been declining, suggesting that the market is attempting to determine a bottom. It is a great reversal pattern and is a strong signal that a bottom has been put in and it's time to buy. The longer the wick, the stronger the reversal. Number 10. Shooting Star Candle. The shooting star candle pattern is the opposite of the candle and is a bearish pattern that also forms in a single trading day. This bearish candlestick occurs when a stock trades much higher than its opening price only to be sold off and drop. The price closes lower than the opening price, forming a large upper wick. The wick is at least twice the size of the real body. The shooting star signals the top after a stock has been on an uptrend and is now being heavily sold off. It is a strong reversal pattern, one warning to sell and take profits as more downside will occur. The longer the wick, the stronger the selling. Number 11. DOJI. In Japanese, DOJI means blunder or mistake. In candlestick patterns, it refers to an opening and closing price being exactly the same. This too is a pattern that occurs in a single trading day. A DOJI candlestick often indicates uncertainty and fear. These candlesticks look like a cross, inverted cross, or a plus sign, as these are associated with uncertainty and fear. If this pattern reveals itself, it's best not to be invested in the stock until the direction of the price becomes clearer. Well, there we have it, 11 candlestick patterns to get you started analyzing stock charts. If you enjoyed this video, give it a like and be sure to subscribe and turn notifications on to be notified when a new video comes out so you can receive all the latest financial tips. And if you know someone who would benefit from this video, please share it with them. We've covered a lot in this video. Everything from what are stock price candlesticks, the different parts of it, and a handful of the most common bullish and bearish patterns. Armed with this new information, start looking at stock charts and see if you can identify the patterns mentioned in this video. And go back and study the patterns we shared with you today to assist you. And specifically, we recommend starting by looking for a bull flag pattern on a stock chart, as these patterns are the most obvious candlestick patterns to identify. Once you've got that pattern down, you'll start seeing all the other patterns on other stock charts if they are present. This is a powerful skill to have and will allow you to make smarter investment decisions and money in the stock market by correctly predicting where the price of a stock will go next. Well, that's it for today's video. Make sure to comment on what you learned or how you plan to use what you learned today. We love to hear from you, and I will see you in the next video.